So we're diving into some pretty interesting stuff today. Did you know that multinational corporations are using tax loopholes and policy shifts to navigate this whole global inflation thing? It's kind of a big deal with billions of dollars at stake. And we've got a ton of sources to unpack: financial reports, economic analyses, academic papers, you name it.
Yeah, it's pretty amazing how companies are adapting, especially with all the complexities of how inflation affects taxes and regulations.
Exactly. And we're not just talking theory here. We're going to look at real-world examples of how these strategies actually play out in different regions.
It's really crucial for CFOs to understand these trends, not just for compliance, but also to maybe even gain a competitive edge.
Absolutely. Let's start with this global inflation puzzle. It's definitely not a one-size-fits-all situation.
Right.
For example, the Chicago Fed report shows how housing costs are a major driver of the inflation differences we see across the U.S.
Oh, yeah. That's a huge detail for multinational corporations with operations in different parts of the country. Like, imagine having a bunch of employees in a region where housing costs are going through the roof.
Right.
That directly impacts your labor expenses and your overall profitability.
And the report breaks it down even further,
Yeah.
showing how the CPI, that key measure of inflation, has risen at different rates depending on the region.
Interesting.
Between 2019 and 2023, the West saw the highest inflation at 19.5%, while the Northeast had the lowest at 16.6%. That's a pretty significant difference.
Yeah, it is.
CFOs need to factor that into their financial planning.
It's not just about knowing the overall inflation rate, but understanding how those regional variations impact your specific business.
Right.
Are you ready for those potential cost increases in some areas? Have you thought about adjusting your pricing strategies or your supply chains? These are the questions CFOs should be asking.
And then there's the whole global picture. We can't forget about China's economic resurgence, especially after their COVID lockdowns.
Yeah.
Goldman Sachs is predicting a rebound in commodity prices, driven partly by China's increased demand. That's going to have a ripple effect worldwide.
It's like a chain reaction. China's demand pushes up commodity prices, and then that impacts businesses all over the world that rely on those commodities. It's a tough environment for CFOs.
Yeah?
Having to anticipate these price swings and manage their supply chains.
It really shows how interconnected the global economy is.
For sure.
And speaking of interconnectedness, we can't forget about governments and how they try to control inflation,
Right.
like fiscal policy, for instance.
One tool they have is raising taxes.
Right.
The idea is to lower consumer demand and cool down the economy. There's an article called How to Fix Inflation that explains this. But, politically, tax hikes are really hard to get people on board with, especially when the economy is already struggling.
It's a tough balancing act for governments.
Totally.
They need to control inflation without causing a recession or, making everyone unhappy.
Right, and that's where the idea of a soft landing comes in. It's about managing interest rate hikes and other policies carefully to slow down inflation without a big economic crash. But even interest rate hikes can backfire, especially with a volatile housing market like what we're seeing in the U.S. That article points that out.
So how does CFOs make sense of all this constant change, especially when it comes to taxes?
Well, that's where things get interesting. We're seeing companies come up with some pretty creative strategies.
Like what?
One that's been getting attention is skimpflation. It's basically a way for businesses to subtly shift costs onto consumers without actually raising prices.
Interesting.
There's a Psychology Today article that goes deep into how companies are doing this, from shrinking product sizes to cutting back on customer service. It's a way to maintain those profit margins, but it does raise some questions about transparency and if customers are really getting their money's worth.
Yeah, I wonder about the long-term impact on brand loyalty. Like, what if people start feeling like they're getting less for their money?
That's a good point. It shows how important it is for businesses to think about how these strategies affect their relationship with customers. Transparency and communication are key even when you're trying to cut costs.
For sure. But while skimpflation deals with the consumer side, CFOs are also looking at tax planning strategies to manage their bottom line, right?
Exactly.
This is where we see the impact of these changing global tax policies.
We're seeing a rise in the use of offshore structures and transfer pricing to optimize those tax liabilities. These strategies are becoming more and more important, especially with all the efforts to prevent BEPS, which is basically corporations shifting profits to low tax places.
BlackRock, that big investment management company, has some interesting analysis on this in their Global Outlook report.
Yeah, they talk about how multinationals are adapting to these evolving tax policies, which are designed to close loopholes and make sure everyone's paying their fair share.
It sounds like a global chess match, with companies trying to minimize their taxes and regulators trying to stay one step ahead.
And the stakes are high. The OECD, which has been a major player in the fight against BEPS, they have a whole website dedicated to tracking these policies and giving guidance to both corporations and governments. It's a valuable resource for any CFO trying to navigate this stuff.
That's super helpful. So we've established that the global economic landscape is this complex web of interconnected factors, with inflation, tax policies, and corporate strategies all playing a part.
Definitely. It's a dynamic environment that requires CFOs to be agile, strategic, and always learning. Which brings us to our next point.
Okay, so we've been talking about this strategic chess game corporations are playing with global tax policies. But there's another piece of the puzzle that we need to think about, right? The future of financial systems themselves.
Oh, absolutely. The way we think about finance and investment is changing in a big way, driven by these huge economic trends like the move towards a low-carbon economy and, the rapid development of artificial intelligence.
Yeah, those are some pretty massive shifts. So how are those trends impacting how companies approach their financial strategy?
Well, that BlackRock Global Outlook report that we mentioned, it really emphasizes how we need a fundamental shift in investment thinking. They're arguing that these mega trends are going to require huge, huge investments, potentially on the scale of, like, the Industrial Revolution.
Wow, that really puts things into perspective. So are they basically saying that traditional investment approaches aren't going to cut it anymore?
Yeah, they're suggesting that the classic 60/40 stock bond portfolio, which, has been considered the standard for balanced investing for so long, might not be enough to capture the full potential of these emerging trends.
So instead of just putting money into these broad asset classes, investors need to be more strategic and align their portfolios with specific themes that are, actually driving the economy forward.
Exactly. And BlackRock specifically highlights private markets, things like private credit and infrastructure, as areas with a lot of growth potential.
It's interesting. It sounds like private markets are becoming more and more appealing to investors who want those higher returns and maybe a way to hedge against inflation. But what about the role of technology in all of this? I mean, AI especially seems like it's ready to completely disrupt the financial services industry.
Oh, absolutely. And there's this Deloitte survey on generative AI and financial services that shows a really interesting divide. They call them pioneers and followers. The pioneers are the early adopters, the ones who are aggressively investing in generative AI and think it can totally transform their organizations within a year.
So they're really betting big on AI, huh?
Right. And the survey data actually shows that these pioneers are putting a lot more of their AI budget into generative AI compared to the followers. They see it as a key strategic advantage.
Yeah, that makes sense. They're willing to take some risks to stay ahead of the curve and hopefully see those big rewards from adopting early. But, it brings up a question. What does all this mean for CFOs trying to figure out this rapidly changing financial landscape?
It means CFOs have to be adaptable and open to these new technologies. They need to be able to assess the potential benefits and risks and make smart decisions about how to use them strategically.
So it's not just about jumping on the AI bandwagon. It's about thinking carefully about how these tools can actually solve real business problems and create value.
That's it. And that brings us back to how important it is to stay informed, to stay on top of the latest trends and developments in finance and technology. CFOs who can do that will be in a much better position to guide their companies through these crazy times and come out even stronger on the other side.
Yeah, I totally agree. We've covered a lot from that global inflation puzzle and the evolving tax landscape to the power of technology and the rise of these private markets. But now I'm kind of curious about something we talked about earlier. We were just talking about how CFOs need to be so adaptable and strategic in this, rapidly changing financial world. But what are some actual things, some concrete steps that CFOs can take to deal with these challenges and even use them to their advantage?
Well, one key area is revisiting that investment strategy.
All right.
Remember how we were talking about BlackRock's Global Outlook report?
Uh-huh.
They suggested, maybe moving beyond just relying on stocks and bonds and looking into alternative asset classes like private credit and infrastructure.
So diversifying into those, I guess, less traditional markets could help CFOs hedge against inflation,
Yeah.
right? And maybe even find some new ways to grow.
Exactly. Private markets can often have higher returns and might not be as closely tied to public markets. So that can be a buffer when things are uncertain economically.
That makes a lot of sense.
Yeah.
What about technology? We talked about how AI is changing the financial services industry,
Yeah.
especially with generative AI becoming such a big deal. How can CFOs really use these advancements effectively?
Well, it's all about finding that balance between embracing new things and managing risk.
Right.
Remember that Deloitte survey we talked about when comparing AI pioneers and followers?
Yeah.
The pioneers are the ones actively investing in and actually using generative AI solutions. They are seeing really significant returns compared to the ones being more cautious.
So being an early adopter of AI could be a real game changer for CFOs who want to get ahead in their industries.
Absolutely, but it's not just about using technology for the sake of it, CFOs need to figure out where AI can actually solve real problems, where it can make a difference and drive results.
Like AI could help automate those repetitive tasks, make fraud detection systems better, even improve how they make decisions in areas like investment allocation, right?
Precisely. There are so many possibilities. And the CFOs who are open to experimenting, the ones who think outside the box about using AI, they're the ones who will probably thrive in this evolving landscape.
This has been such an insightful conversation. As we wrap up, is there one key takeaway you want CFOs to remember from our deep dive today?
I think the main thing is that the global economic landscape is constantly shifting. It's full of challenges, but it's also full of opportunities. And the CFOs who are adaptable, who can use technology in a smart way, and who stay focused on their long-term goals, those are the ones who will successfully navigate these turbulent times.
It's not just about riding out the storm. It's about harnessing those forces to push your organization forward. And with that, we'll leave you with this final thought. As you figure out all these complexities, remember that the decisions you make today are going to shape the financial future of your organization. Choose wisely and make those decisions count.
Thanks for joining us on this deep dive. We'll see you next time.